Good morning, Hemant. Thanks for being with us on NDTV Profit. Now, we've kick-started earnings season for the fourth quarter on a disappointing note. Infosys largely disappointed. Some of the other earnings have also not been in line with what the street was estimating. What do you make of this? The markets have also turned sluggish. Do you think it's time to be cautious now?
Hi, good morning. So, looking at the run-up in the markets we had in the last quarter, some of the sectors are looking worrisome. So, it makes sense to be somewhat cautious as we go into the earnings season. This is also the annual season, so many companies will give guidance for the next year, and that may also give direction to the market in the near term. So, overall, as we enter the earnings season, it's better to watch out, which sectors and companies are showing positive trend. Some of the companies may show good year-on-year growth because the base effect was poor, but that may not really excite the market because that is now in the estimates. So net it makes sense to let earnings season pass through and then take a call which sectors are good to invest in.
Right, but what is your expectation for the markets? Do you think they will remain range bound, or are they ripe for a correction? Given that geopolitical tensions around the world have also risen, do you think markets could correct?
So near term it is possible, and not because of this event, but just because of the run-up we had in the last quarter. It was one of the big rise. Even rupee had one of the strongest appreciation in couple of years. So that shows that interest in the Indian equity markets in the overall economy has been pretty strong in the last quarter, and so that itself may lead to some cool off in the coming quarter. We also will have to live with the worries on monsoon, which initial indications are that it can be weak. Hopefully, we believe that government will respond positively to it and help in controlling the inflation. But at least markets will be worried about it. So this quarter, you may see some consolidation happening in the market after a strong move we saw in the March quarter.
Right, consolidation. And as for earnings, what is your expectation? From the start, it doesn't look like a great omen, but do you think there could be earnings pockets where we could see outperformance? And on a Sensex or Nifty basis, what kind of earnings are you penciling in for Q4?
So broadly, the expectation for Nifty is in the range of 10%, and for the broader market, it can be higher because many of the sectors which are now part of the Nifty now, mainly say PSU banks and metals, are expected to show good earnings growth because of base effect. Having said that, key is not what kind of growth comes in this quarter, but what will happen, the way forward, and that is where clarity is not there, and we need to wait for it, as I said, in this earnings season.
All right, so 10% growth for the frontline indices. Which are the areas of outperformance? Now, Infosys started on a weak note, and perhaps technology will not have a great run. But where can we see outperformance when it comes to earnings growth?
So metals have been doing well, and last year, if you see, the March quarter was the bottom of the for many of the companies. So they are expected to show a good earnings growth. There is some softness on metals, but those sectors don't move on past earnings because the outlook is more important, and there are some worries getting built on it because we are not seeing good infrastructure push happening in USA. So you may see some softness in the commodities in the near term, which can be used to add exposure there tactically, because the data we believe from China and USA will continue to remain strong in the coming quarters. So commodities is one segment where one can look to buy into the disappointments. Other sector which will be area of interest will be domestic consumption. There again, full impact of demonetization may be felt in the in the March quarter, but we believe that the recovery from March onwards has been pretty good, and so that sector will continue to show good growth going ahead. So these are the two segments which look interesting from a result point of view.
All right, so commodities is expected to be strong. Where do you think the biggest disappointment will come from? IT, where we've seen that Infosys has come out with a weak set of earnings, or could it be some of the PSU banks? Where do you see disappointment in earnings?
So IT, we don't believe is a disappointment because earnings were expected to remain weak. Now issue is it's very difficult to put a handle on how big it can be. So maybe there is some slowdown even beyond what we thought, but that is will change. So it's not in a way disappointment. So main area to watch will be corporate asset quality, and PSU banks are more exposed to it. So both PSU banks and private banks, that is where the main area of disappointment for the market can be, because there is some expectation that credit cost has peaked out and you should see improving trend going forward. So in the March quarter results you may not see that, but if the company banks continue to guide for elevated credit cost even into FY18, then it will be a source of disappointment for the market. So that is, I think, so the key area to watch out for.
Right. What about the some of the consumer related names? Do you think the impact of demonetization is going to linger on? Would you see low earnings coming in, or lower than expected earnings coming in from autos or cement counters?
So overall, that looks the data. So if you look at the secondary data available for the March quarter, many of the segments have continued to show sluggish growth. As I just mentioned that only in the March month, because of sometimes because of stronger summer or whichever the factor, we are seeing recovery happening in the March quarter, and that's where the companies' commentary on how they see the immediate quarter as well as the next year is going to be a relevant factor. So you may see some weakness in earnings because sales have been sluggish in January and February. But because of some pickup happening in March, and if companies shows confidence on that, then there will be taken positively. So that is what you have to watch out for. So like for example, Titan came out with their commentary and they said they are seeing reasonably buoyant growth in the jewelry segment. So market got excited about it. So that is what it is going to be. So we have to see which segment, but overall looks like discretionary consumption has bottomed out, and we are seeing some uptick happening in the going ahead. Only another commentary will be to watch out will be on the GST, because there is an expectation that there might be some destocking ahead of the GST implementation on July 1st. And if that happens, then again this quarter may see some impact. So what kind of guidance company give on that front also will be important to see.
All right. So when it comes to heavyweights like HUL and ITC, what's your view on these counters from the consumer space?
So obviously they both operate in a different segment, and drivers can be different. But say companies like HUL, so they are a pretty large company. So for the ability for them to grow faster than the industry becomes in a way limited. So they will get impacted by whatever is happening in the economy and the market. So sales can remain sluggish for the segment as well as for the company. So we don't really comment on any particular company, but sales will remain sluggish for the consumer sector in the March quarter. And that's why again to reiterate, we have to see what kind of confidence they exhibit for the FY18, and that will be important to see. For companies like ITC, I think so what kind of tax rates they get into GST will be an important event.
Right. What about some of the other consumer names like airlines? What kind of performance are you expecting there? Some of the consumer durable companies, consumer electric companies like Havells and Voltas have had a good run. What are you expecting by way of earnings from these companies as well?
So again, March quarter has been relatively on the weak side only. So in some segments they have done better when we interact with these companies, but overall sales will continue to remain sluggish for them. So overall, if investors should not look at March quarter and invest as such, these are the companies where valuations are also relatively high. So you cannot be investing with immediate quarter in mind. So you investors need to take somewhat longer term outlook when the valuations are high. And that outlook continues to remain pretty strong for these companies, because the segments they are in are very underpenetrated in India. So at the industry level, as well as there can be shift from unorganized to organized in this segment. So medium-term prospects for these companies look good, but maybe the March quarter, or maybe because of GST impact, even the June quarter may be on the weakish side. If there are some correction in these sectors on the back of weak earnings or GST, investors can look to add exposure to that.
Hemant, you mentioned that you are worried about asset quality and how does it go through for private banks and PSU banks. But retail side of asset quality has done well. Corporate side, a lot of steps are being taken. Over the weekend also, you had some framework which was announced by RBI for banks to follow. Do you think we are the worst as far as corporate asset quality is concerned, and things can only look up going ahead?
So that is what the expectation is, but we don't have any firm evidence of it. That's why the results are important, because finally management has to come and guide for it, that what kind of stress they are seeing on their book. So we can make only an assessment of which sectors are having issues, but exactly which exposures banks have and what is the creditworthiness of them. That analysis only management can provide us. And as of now, there is an expectation, but when you look at the broader data, it still looks weakish. So you may see some improvement happening in metal side because of the rally in global commodities. But something like power, we need to watch whether there is an improvement or we are seeing deterioration. Because when you analyze the data of publicly listed companies, many companies, interest coverage ratio or debt to EBITDA still look worrisome. So, finally we'll have to wait for the guidance from these banks, and if the guidance remains weakish, then, it will be disappointing for the market.
Right, but guidance for some of these asset quality, it's been very difficult to predict. You think only when the numbers reflect a sign of change as far as asset quality is concerned, only then the market will pay a higher multiple?
That's true. That's where, in spite of the improvement, many of the corporate banks are still trading at a very cheap multiples compared to their own history. So that worry remains, because finally you may see improvement for 1 quarter or 2 quarters, but there is no guarantee that deterioration may not happen going forward. So unless we see system-wide improvement, big re-rating is going to be difficult. Obviously, investors will pick and choose within the segment. Because after having a pain of almost 2 to 3 years, there is increased expectation that we might be at the peak of the credit cost, and if things start improving from here, then even the loan growth can improve for them. So then they can offer a opportunity to make good returns from these banks. But issue is what we are not clear about is, are the worst of the problem behind? Even government is trying their own bit, but there seems to be no clear solution to it. And we need to keep on monitoring this issue continuously.
Can you also just tell us about valuation of these corporate banks? Do you think valuations are not factoring in any recovery for some of the large corporate banks?
Not really. So if you believe, look at some of the banks have performed very strongly in last 1 year, particularly on the PSU bank side. So they are factoring in now that recoveries will happen, particular government support will come. So some expectations are there. Obviously, it's not fully built in. So in case we see stronger recovery, then they can continue to do well. But it is not that there are no expectations today. So there are So that's why I said that today there is a differentiation between the banks, and some of the banks which have done well. Obviously, the expectations are more. That things have maybe bottomed out for them. Credit cost has picked out, and we will not see increase, at least slippages. Credit cost can continue to remain elevated because that depends on the maturity or the aging profile of the NPAs. But at least we don't expect increase in slippages for these banks. So if you don't, and in the March quarter it's possible it happens because normally year-end provisioning. But again, guidance for the next year will be a critical factor.
Right. Do you think any solution as far as NPAs are concerned would be positive for the entire market as well? The entire market is waiting for it, not only the bank shareholders.
Again, that's true because finally banks have to give credit for the economy to grow faster. So it is always debatable whether growth leads to credit growth or credit growth leads to economic growth. And to some extent, credit growth is required because if banks are not willing to fund the growth and interest rates really don't come down to the extent they need to be, then economic growth also at a faster rate is not possible. So finally, a healthy banking sector is a prerequisite for faster economic growth, and that's where it is important. So if investors start getting confidence on the asset quality of these corporate banks, then overall markets can also re-rate, and you will actually see better economic activity going forward.
Since 2015, there has been a change as far as NBFCs are concerned. What has changed? Why do you think investors are playing this growth via NBFCs versus banking names?
So two factors have played out. One is as interest rates come down, and many of these NBFCs are wholesale borrowers. They benefit on the spread side. So that was number one. Unlike many of the banks which are high on CASA, they don't benefit to that extent when the interest rates come down. And second was because of inability of PSU banks and to some extent even private banks to focus on retail segment because they were trying to resolve their asset quality issues. Some of these NBFCs could grow at the cost of PSU banks, and so they were able to show high double-digit growth when system-wide credit growth is in single digit. So two factors, basically faster loan growth and better spreads, had led to re-rating of these NBFCs. But as banks come back with credit growth, obviously there can be valuation gaps can narrow going forward.
Also, you think that businesses like microfinance, businesses like housing finance are perpetual businesses which people are realizing that they will continue to grow 10-12% year after year?
So they are overall, if you see credit penetration in India, particularly on the retail side, is pretty low. So the way we see the trend is that credit disintermediation is happening. So we will see larger corporates trying to access the bond market directly because they are able to get cheaper funds, and hence more and more banks will have to focus on this smaller ticket size, whether we call it microfinance, affordable housing, to make their spreads. And that is what I think the real role of the bank is, that you collect deposits at the retail level and also lend at the retail level. Not because it is very exciting today, because but these small borrowers are not able to access the credit market, and that is where the banks have to provide the credit to. Large corporates can have many sources of funds, and there the bank's exposure should as such be limited. So I think so market is moving in the right way, and microfinance and housing are very important to have a sustainable economic growth. So as banks increase their penetration there, it is beneficial for everyone.
Right. When you were talking about the Q4 numbers, you told that consumer names will do well, consumer durables, because March the data or the initial commentary is good. Do you think GST and what are the benefits for some of these branded consumer name is something also which market is looking at, that is also factored in after the recent run-up?
So what I said is that actually March quarter may not be great because Jan-Feb, from whatever we understand, was not good, and there is some pickup happening only in March. So the quarter may not be that great, but commentary can look buoyant for these companies. The impact of GST in June quarter can be somewhat vickish because there can be destocking, but outlook for these companies post GST implementation again is good, and that's why that is reflected in the higher multiple for these companies currently. So overall, the expectation is that things will improve for them post GST implementation, and so particularly second half of FY18 should look good for them. That is the current expectation.
Right. Till now, you look at any other consumer company where there is a lot of unorganized market, it has always grown because it has taken market share from the unorganized play. You think GST will just make it faster for them to capture unorganized market?
So GST is not about, in a way organized, unorganized, but it is not only, I'm saying organized should not be mistaken as listed entities. Organized are one who are compliant with the regulatory requirements. So the problem has been that many of these unorganized players have not been complying with the regulatory requirement, whichever way it is, either taxation, labor laws, and various things. They try to save cost out there and be competitive. So GST will make that difficult. So organized, when we say it is, whether listed or unlisted, but who are, complying with the regulatory requirements of the country, and obviously they benefit, and that has to be the trend, because they finally offer, better quality product to the consumer, as well as are also fair to the other stakeholders. So that the trend will continue in most of the industry.
Right. Hemant, we had a big India Bulls real estate deal that came in today, because of which the debt is likely to go down. Their commercial business is likely to get separately listed. You think any sort of movement towards listing of REITs or any commercial asset, any commercial paper which can give you yield in the market, and markets you think would reward some of these real estate companies in a strong way?
So any company, the issue with many of these companies has been, balance sheet stress, and any move which happens which reduces that leverage will help in, re-rating the company, because the risk comes down. They have large asset base, so enterprise value of these companies are large, but large part of their enterprise value today is captured by debt, and equity is a smaller component. So what we saw happening to metal companies last year, that as metal prices started moving up, equity value went up, and overall there was a disproportionate gain to the equities from gain in EV. Similar thing can happen to any company which is over leveraged, and real estate is one of them. So either it is REIT or there is fresh equity, whatever they do, but if they start reducing the debt, which reduces the riskiness of the company, it will help in re-rating these companies.
Hemant, thank you so much for taking out time for us. Always good to get a perspective from you.